Welcome, curious minds. In a world teeming with data, trying to get truly well-informed about a company's investment potential can feel, well, like trying to drink from a fire hose. Today, we're not just cutting through the noise, we're sifting for gold. We're embarking on a deep dive into Pegasystems Inc., NASDAQ Q ticker PEGA. Now, this isn't just another enterprise software vendor, it's a firm strategically positioning itself right at the very heart of how major corporations make decisions with AI and automate their most critical workflows. Our mission for you today is really a shortcut. To unravel Pega's intricate business model, understand its bold, multi-year strategic transformation, dissect its competitive landscape, and critically examine the financial and, importantly, legal factors that every informed individual needs to grasp.
Absolutely. Think of this as peeling back the layers on a high-stakes game. We'll explore why PEGA matters, especially for those watching how major enterprises are genuinely undergoing digital transformation, not just, talking about AI, but really implementing it through AI. We'll uncover the core differentiators that give them an edge, dig into the numbers, validating their strategic shift, and lay bare the significant risks and opportunities that define its investment profile right now. You should walk away with a much clearer picture of what makes this company tick.
Okay, let's unpack this then. What exactly is Pegasystems, and what makes it tick at its very core?
Right. So at its core, Pegasystems proudly calls itself the Enterprise Transformation Company. Their fundamental value proposition, it's all about empowering large, complex organizations to do three key things: unify their customer experiences, automate customer service, and streamline those mission-critical, often highly regulated operations. You see, Pega wasn't just born yesterday. It was founded way back in 1983 by Alan Trefler. It actually evolved from a business process management, or BPM, specialist into this comprehensive provider of customer engagement and intelligent automation solutions. So this long history, it gives them a depth of experience many newer players simply don't have.
So they've been around for quite a while building that foundation. What's their core game plan for, today and the immediate future?
Their corporate strategy is really multifaceted, but elegantly focused, I'd say. They aim to increase their share of the enterprise software market by delivering a highly differentiated platform, one that seamlessly integrates AI and automation. The key strategic pillars are sort of twofold. First, deepening and expanding relationships with their already formidable existing client base. Think many of the world's leading global brands and government agencies, big names. Second, they're methodically establishing new client relationships within the Global 2000. This isn't about chasing every small business deal. It's really about securing high-value, deeply embedded solutions that become, indispensable to their clients' operations.
And this embedding concept sounds crucial, creating a powerful lock-in effect. You mentioned something called a center-out approach in their situational layer cake architecture. Can you explain what these mean, and more importantly, why they create such significant operational switching costs for clients? That sounds key.
That's a fantastic point to highlight, yes. The center-out approach is a truly unique architectural philosophy. Instead of building systems from the outside in, focusing on individual channels like a mobile app or a website, Pega designs its solutions to connect disparate systems and channels by orchestrating business processes from the customer's perspective. So imagine a customer interacting with a major bank across multiple touch points. Maybe they start online, then call customer service, and then maybe visit a branch. Pega's center-out design aims to ensure a consistent, intelligent experience and a unified view of that customer, no matter the channel or the complexity of the underlying process.
Okay, so it follows the customer journey, essentially.
Exactly. Now combine this with their patented situational layer cake architecture. To make this vivid, imagine a master chef who doesn't just make one meal, but designs a core recipe, the cake, that can be easily adapted with different layers or ingredients for various customers or occasions. That's kind of like Pega's architecture. The underlying cake of business rules and processes is consistent across the enterprise, but they can quickly layer on specific adaptations for, say, a bank's lending department versus its wealth management, or for different regional regulatory requirements without rewriting everything from scratch.
So it's about reuse and adaptation.
Precisely. It creates incredible efficiency and makes the system deeply resilient to change. What this means for you, our listener, is that it creates a truly powerful lock-in effect. Once an organization adopts this framework for a critical process like global client onboarding for a major bank or managing complex insurance claims across different product lines, replacing that PEGA system involves a fundamental re-architecting of their core business processes.
So it's not just the cost, it's the sheer operational upheaval we talked about earlier.
Exactly. It's not just about high financial switching costs. It's about deeply operational dependencies. Think of it this way. PEGA isn't just a part of the engine. For many of these operations, it's the chassis. Changing the chassis means effectively rebuilding the entire vehicle,
Wow.
making it an almost unthinkable task for a large enterprise. This isn't just about high switching costs, it's about making PEGA an indispensable operating system for their most critical functions. It really offers insight into why their client churn is so low.
Right.
This operational dependency is really the bedrock of their competitive moat and the stickiness of their revenue base. It's incredibly difficult to rip and replace.
That analogy of the chassis and the master chef really helps crystallize it. Okay, so that's the architecture and philosophy. What about their actual solutions, the products, and how do they generate revenue from them?
Right. Their offerings are consolidated under their flagship software portfolio, PEGA Infinity. It's all built on a unified cloud-native platform designed for agility and scalability. Within PEGA Infinity, they offer three core solution areas. First, 1.1 customer engagement, which goes far beyond traditional CRM. Its centerpiece is the PEGA Customer Decision Hub. This is a real-time, AI-powered engine that analyzes customer data and context to deliver the next best action at every single interaction point.
So hyper-personalization in real time.
Exactly. It's all about maximizing customer lifetime value. Imagine your bank knowing precisely what offer or advice to give you exactly when you need it across all channels, all driven by AI. Second, they have customer service applications like PEGA Customer Service. This aims to simplify and automate service operations, providing a unified desktop for contact center agents, AI-powered case management that intelligently adapts to service requests, and robust tools for omni-channel self-service, including virtual assistants and chatbots. And third, their foundational strength, intelligent automation. This is built on their deep expertise in business process management and digital process automation. The core PEGA platform provides the tools for AI-powered workflow automation, dynamic case management for handling complex, long-running processes like, say, benefits claims, and robotic process automation, or RPA, to automate repetitive tasks and bridge legacy systems that might not talk to each other directly.
Okay, so those are the powerful solutions. How do they actually translate into revenue for Brock?
Yeah.
Where does the money come from?
Good question. Their revenue streams really reflect their strategic pivot to recurring subscriptions, which we should definitely dig into more. The primary focus and main engine of growth today is PEGA Cloud. This represents revenue from their hosted software as a service, or SaaS, offerings. Then there's client-managed deployments. This is for clients who choose to deploy PEGA software on-premise or in their own private cloud. This includes term-based license arrangements and maintenance revenue for ongoing support, software upgrades, bug fixes, that sort of thing. They also generate revenue from consulting, which covers professional services related to software implementation, training, and strategic guidance for their, frankly, complex solutions. Lastly, there's a legacy stream from perpetual licenses, which they are actively, deliberately de-emphasizing in favor of those more predictable recurring subscriptions.
Now, here's where it gets really interesting for anyone watching this company for a while. As you said, this wasn't always a cloud-first company. What was that multi-year transition like? I mean, why was it so important for their long-term health? That must have been a huge shift.
Oh, it absolutely was. It was a truly deliberate and profound multi-year transition spanning roughly from 2017 to its substantial completion in 2023. They made a fundamental shift from relying on upfront perpetual license sales. Think of it like selling a software package just once to a recurring subscription model, heavily centered on their PEGA Cloud offering. The stated goal was to transform from what they called a perpetual, less predictable, lagging growth and margins business into a recurring, more predictable, Rule of 40-driven enterprise.
Ah, the Rule of 40.
Yeah.
Can you quickly remind our listeners what that is?
Sure. For those unfamiliar, the Rule of 40 is a common SaaS industry benchmark. It essentially suggests that a healthy SaaS company's revenue growth rate and its profit margin should add up to 40% or more. Think of it like a car's performance. You want a good balance between speed, growth, and fuel efficiency, profit.
Right.
If your car goes, say, 30% faster year over year, and its profit margin is 10%, you've got a total performance score of 40. PEGA is aiming for that sweet spot of combined growth and profitability. It's a sign of a healthy, sustainable SaaS business.
That sounds like a massive undertaking, though. especially for a company with such an established customer base. I imagine there must have been some tense board meetings during those years, watching those GAAP revenue numbers kind of wobble during the shift.
Absolutely. You hit the nail on the head. This transition had a significant and at times, yes, painful impact on their reported financials. Under traditional accounting rules, perpetual license revenue is recognized upfront, which can lead to lumpy, high-revenue quarters. Subscription revenue, however, is recognized ratably over the contract term. So during the shift, reported GAAP revenue growth was definitely suppressed, and operating cash flow was negatively impacted, even though the underlying health of the business, measured by those recurring commitments, was actually improving significantly. Management consistently directed investors to focus on forward-looking metrics like annual contract value, or ACV, and remaining performance obligation, RPO, as the true indicators of their progress.
Right, the underlying commitment value.
Exactly. Now that the transition has largely matured, we're finally seeing the financial benefits becoming really evident. Accelerating ACV, a rapidly growing backlog, and a dramatic, really dramatic inflection in free cash flow generation. It was indeed a difficult but necessary surgery, as you might say.
And that deep integration we talked about, the operational dependency, the chassis analogy, that means their revenue base is incredibly sticky. Right? It's not just about a product. It's about embedding themselves deep into the client's operations.
You've hit on a critical point again.
Yes.
It's inherently sticky. Pega solutions aren't just, nice to have add-ons. They're used to run mission-critical core business processes that are incredibly complex and often highly regulated. Think about the entire end-to-end process for Know Your Customer or KYC compliance for a global financial institution.
Where mistakes are very costly.
Hugely costly. A single misstep can lead to massive fines. Or consider the entire claims adjudication lifecycle for a major insurer. Once deployed, these systems become deeply integrated with numerous other enterprise applications and data sources across an organization. The operational risk, the massive disruption, and the sheer cost of replacing such a deeply embedded platform are substantial. This leads to very high client retention. The company actually disclosed in its Q4 2023 investor presentation that its overall client renewal rate exceeds 90%.
90%, that's high.
It is. It's a testament to the durability of its revenue base. This high retention, combined with the successful shift to a subscription model, provides a really strong foundation of predictable, recurring revenue. It's not just difficult to replace, it's often more painful to replace than to stick with PEGA.
So with all this capability and stickiness, how big is the market they're playing in? Is that sandbox growing, and how are they positioning themselves within it? It sounds like it could be huge.
It is. The total addressable market, or TAM, for Pegasystems has expanded quite significantly over the past few years. This reflects both the natural growth of its underlying markets and, interestingly, a deliberate strategic repositioning of the company itself. Back in early 2022, they framed their opportunity as a $50 billion-plus digital transformation market. By late 2023 and early 2024, this estimate jumped to an $89 billion-plus market opportunity. Their Q1 2025 investor materials continued to cite a $90 billion-plus market opportunity, and by mid-2025, one analysis even projected it to expand to $150 billion by 2028.
Wow, that's a big jump.
It is. And at an investor conference in August 2025, their CFO and COO, Ken Stillwell, conservatively stated the TAM is $100 billion a year, while, personally arguing it is much higher.
Yeah.
Now, this rapid expansion of the perceived market opportunity isn't just market inflation. It signals a deliberate strategic shift. The company is no longer defining itself narrowly as just a competitor in BPM or CRM markets, but as a foundational enterprise transformation platform.
So broadening the scope.
Exactly. This broader definition allows PEGA to target a much larger pool of enterprise IT spending, specifically the budgets allocated for modernizing decades-old legacy systems and for orchestrating new AI-driven initiatives across the entire enterprise. So the TAM is growing, in part because PEGA's definition of its role within its client's technology stack is expanding. Their serviceable addressable market, or SAM, primarily consists of those Global 2000 organizations and large government agencies. They have a strong foothold in several key verticals, including financial services, insurance, healthcare, telco, manufacturing, and the public sector.
It sounds like PEGA is truly operating at the crossroads of some massive and rapidly evolving markets, each with its own dynamics. Can you walk us through those industry trends and, crucially, the major players they're up against?
Yeah, PEGA really does sit at the intersection of several large and dynamic segments of the enterprise software industry. Each of these markets is characterized by strong secular growth tailwinds driven by those overarching themes: digital transformation, cloud adoption, and the increasing infusion of AI. Take customer relationship management, or CRM. This is a mature market, yes, but it's still growing. Various research firms project its size to reach between, say, $123 billion and $163 billion by 2030. That's expanding at a compound annual growth rate, or CDR, in the high single digits to mid-teens. The market is overwhelmingly dominated by cloud-based SaaS solutions. Gartner said over 79% of all CRM sales were SaaS back in 2020.
Okay, so CRM is huge and mostly cloud.
Then there's business process management, or digital process automation, DPA. This is Pega's historical core, remember. This market is experiencing really rapid growth as organizations seek to enhance business agility and operational efficiency. Market estimates project this segment to grow from roughly $21 billion in 2025 to over $70 billion by 2032. That's a robust TTAGR of around 18.6%.
Significant growth there, too.
And perhaps the most rapidly expanding segment is low-code, no-code, or LCNC platforms. This is just exploding, fueled by a chronic scarcity of professional developers and this insatiable enterprise demand for faster application development and digitalization. Research firm IDC forecasts an exceptional CAGR of nearly 38% for the LCNC and intelligent developer technologies market through 2028.
38% CAGR. That's massive.
It is. The trend is so pronounced that Gartner predicted that by 2025, 70% of all new applications developed by enterprises will utilize LCNC technologies. That's up from less than 25% back in 2020. So yes, these are incredibly vibrant and growing markets Pega plays in.
Okay, so they're in these massive markets, but as you said, they're certainly not alone. Who are the big players, the household names, and how does Pegasystems manage to position itself against such formidable competition?
All right, the enterprise software landscape is intensely competitive. It includes some of the largest, most well-capitalized tech companies in the world. Pegasystems navigates this environment by focusing on a differentiated strategy. It's centered on depth and complexity rather than just breadth and volume. First, you have Salesforce, the undisputed leader in CRM, commanding market share between, say, 24% and 29%. Salesforce's primary strengths are its massive ecosystem, a reputation for user-friendliness, especially for sales and marketing teams, and, of course, dominant brand recognition.
Everyone knows Salesforce.
Pretty much. But while they're formidable in front-office applications, their platform can be perceived as less inherently suited for the deep, complex, and often regulated back-office process automation that is Pega's core competency. For that global bank needing to onboard a client across 50 different jurisdictions with unique regulatory checks, Salesforce might not be the immediate go-to. Then there's ServiceNow, a dominant force in IT service management, which has successfully broadened its scope to become a comprehensive enterprise workflow automation platform. Its key strengths include a highly intuitive, standardized platform that's a favorite among IT departments, leading to rapid adoption for IT-centric workflows.
ServiceNow is everywhere in IT.
Yes, but while ServiceNow is increasingly competing in customer service and other business domains, it is generally viewed as less adaptable for the highly customized, non-IT, industry-specific processes where Pega really excels. Microsoft, with its Dynamics 365, is a powerful and, frankly, pervasive competitor. Its most significant competitive advantage is the seamless integration of Dynamics 365 with the ubiquitous Microsoft ecosystem, Microsoft 365, Azure, the Power Platform LCNC tools. This integration creates a powerful value proposition and allows for aggressive bundling and pricing strategies.
That bundling power is huge.
It is. However, like other horizontal platforms, Dynamics 365 may be perceived as less specialized for the deep, vertical-specific process requirements that are Pega's focus. And we can't forget Oracle and SAP. These legacy enterprise software titans possess massive, entrenched customer bases in core functions like ERP and database management. The primary strength is their ability to cross-sell CRM and BPM solutions into this captive installed base, their primary weakness. A perception, perhaps, of being less agile, more complex, and less cloud-native than some of the more modern competitors.
So a real mix of giants and specialists.
Exactly. And what's fascinating is that despite its smaller scale compared to these giants, Pegasystems consistently achieves leader status in key industry analyst reports from firms like Gartner and Forrester, particularly for CRM customer engagement center, AI decisioning platforms, and digital process automation markets. This third-party validation is a critical asset in enterprise procurement cycles. It helps Pega compete effectively against its larger rivals. Pega's competitive approach isn't to challenge Salesforce head-on for every single CRM deal. No. Instead, it pursues a focused strategy of targeting the most complex, high-value enterprise challenges that are often poorly addressed by more generic, horizontal platforms.
Focus on the tough stuff.
Right. Its competitive advantage isn't built on being the best simple CRM, but on being the best platform for that global bank automating a multi-jurisdictional client onboarding process, or for an insurance company managing a complex multi-stage property and casualty claim. Success hinges on convincing prospective clients that their problems are sufficiently complex to warrant a specialized, high-end platform like PEGA.
That's a powerful distinction.
Yeah.
So if they're playing in this highly competitive space against these tech titans, how do they protect their turf? What are their competitive moats, those barriers to entry?
Good question. They've cultivated several durable competitive advantages. First, high switching costs, which we've really emphasized. The PEGA platform becomes deeply woven into the mission-critical operations of its clients. The operational disruption, extensive retraining requirements for potentially thousands of employees, and the sheer financial costs associated with replacing such an integral system are exceptionally high. This leads to that very sticky customer base we discussed.
The chassis problem again.
Exactly. Second, technological complexity and intellectual property. The company's unique model-driven architecture has been developed and refined over 4 decades. That's a long time. This deep technological foundation is protected by a substantial intellectual property portfolio, including over 1,200 active patents, with 245 specifically in AI and machine learning. This creates a formidable technological hurdle for any competitor aiming to replicate the unified capabilities of its decisioning and workflow engine. It's hard to just copy decades of R&D. Third is deep vertical expertise. Pegasystems has deliberately cultivated a hyper-focus on its core markets. This has resulted in profound domain expertise and pre-built industry-specific solutions for highly regulated and complex sectors like financial services, insurance, and healthcare. This specialized knowledge is difficult for horizontal platform providers to replicate and represents a significant competitive moat. And fourth, their brand and blue-chip customer base. Having long-standing relationships with many of the world's largest and most demanding enterprises serves as a powerful endorsement and a significant barrier for newer, unproven competitors.
And what about that LC&C explosion? How do they navigate that?
Right, the low-code, no-code market explosion is both a challenge and an opportunity. PEGA's strategic response has been to differentiate its offering by emphasizing its suitability for enterprise-grade low-code development. They focus on robust governance, security, scalability, and mission-critical reliability features, often lacking in simpler department-level LC&C tools. They're saying, sure, you can build simple apps easily, but for the really important stuff, you need our industrial-strength platform.
Speaking of differentiation, how is PEGA handling the seismic shift towards AI-powered business applications? Everyone's talking about AI.
Yeah.
How does PEGA stand out amidst all that noise, especially when they're not building the foundational models themselves, like, say, Google or OpenAI?
That's a critical question, and it speaks directly to their predictable AI strategy. PEGA's response is really smart, I think. They differentiate themselves not by trying to create foundational large language models, or LLMs, but by providing a robust framework for the governed and predictable application of AI within enterprise workflows. It's sort of a dual approach. They leverage the creative power of generative AI in the design phase with tools like PEGA GenAI Blueprint for rapid prototyping and ideation. That's where the creativity shines. But for the execution of live mission-critical workflows within the PEGA Infinity platform, they rely more on deterministic, traditional AI and decisioning rules.
So GenAI for design, traditional AI for execution.
Kind of, yes. It's about using the right tool for the job. This focus on governance, control, and auditability is a crucial selling point for their risk-averse client base in highly regulated industries. For these clients, an unpredictable or unexplainable AI-driven outcome is simply unacceptable. Imagine an AI incorrectly approving a loan or denying a critical insurance claim without a clear audit trail.
Huge liability.
Exactly. This positions PEGA not just as another vendor slapping AI features onto their product, but as a partner that can help large enterprises deploy AI safely and responsibly at scale. The key insight here is that PEGA isn't fighting AI, they're aiming to orchestrate it. They want to be the brain that manages all the other AI brains in a business, ensuring everything works together correctly and predictably.
Orchestrating AI, I like that.
Okay.
Okay, let's talk about the money. Now that they've largely completed this huge strategic pivot to the cloud, what did the latest numbers tell us? How has this transition impacted their financials? Are we seeing the payoff?
We are starting to see it clearly now. Pegasystems' revenue trajectory over the past several years, as we discussed, was heavily influenced by that strategic transition. An analyst from William Blair noted that revenue growth in the years leading up to 2023 was negatively affected, masking that underlying momentum. For fiscal year 2024, the company reported total revenue of $1.5 billion. That was a 5% increase over the prior year. Now, that modest top-line growth, however, it masked a significant internal shift. Pega Cloud annual contract value, or ACV, grew by a strong 21% in constant currency.
21% for the cloud part, okay.
Yes, while legacy maintenance revenue declined by 10% and subscription license revenue fell by 2%, this clearly illustrates the intended cannibalization of older, lumpy revenue streams in favor of the strategic cloud business, which provides that more predictable, recurring revenue. More recently, the first half of 2025 has shown an acceleration in growth. For the second quarter of 2025, total revenues reached $384.5 million, representing a 9.5% year-over-year increase. Total subscription revenues, which now constitute a significant 84.8% of the total.
85% is subscription now.
Almost, yes. That grew 9% to $326 million. This suggests that as the subscription base grows and the headwind from the declining perpetual business lessens, the company's true growth rate, powered by cloud adoption, is becoming much more visible in the top-line numbers.
And what about profitability? Margins must have been squeezed during the transition. Are they expanding now that the cloud business is scaling?
Yes. Profitability followed a similar pattern to revenue. Margins were definitely compressed during the peak investment phase of the cloud transition. However, recent results indicate a strong trend of margin expansion as the cloud business achieves scale and the company focuses on operational efficiency. Overall, gross margins remain robust, reported at 74% for fiscal year 2024 and 71.5% in Q2 2025. But the most significant positive trend, really, is the dramatic improvement in Pega Cloud gross margins. This key metric has expanded from just 51% back in 2019 to an impressive 78% on a trailing 12-month basis as of June 30, 2025.
51 to 78%, that's huge.
It really shows that their high-growth cloud segment is achieving significant economies of scale and becoming a powerful contributor to overall profitability. Operating margins are also on a clear upward trajectory. After a period of pressure for fiscal year 2024, the operating margin expanded to 17.1% from 15.5% the year before. In Q2 2025, the operating margin expanded by 80 basis points year over year to 4.5%. This improvement reflects both the higher margin cloud business becoming a larger part of the revenue mix and a disciplined approach to expenses, with management explicitly adopting that Rule of 40 mindset.
Here's where it gets really interesting, as you hinted earlier. Often, with a SaaS shift, reported revenue can be a lagging indicator, and cash flow tells a very different, often better story. What's happening with their cash generation after this massive transition? Is the cash register finally ringing louder?
It absolutely is. This is perhaps the most compelling aspect of Pegasystems' recent financial performance, the dramatic and positive inflection in its cash flow generation. This serves as the clearest financial validation of that long-term strategic shift to a subscription model, which typically involves upfront annual billing and collections that aren't immediately recognized as revenue. For the full fiscal year 2024, operating cash flow, or OCF, grew by an impressive 59% to $346 million. The momentum accelerated into 2025, with the company generating $204 million in OCF in the first quarter alone.
Through Q1, wow.
Yes, and the free cash flow, or FCF, story is even more pronounced. For the first 6 months of 2025, Pegasystems generated $286 million in free cash flow. Now get this. This figure for just the first half of the year already exceeded the total free cash flow generated for the entire fiscal year of 2023.
The whole of 2023's FCF in just 6 months of 2025.
Exactly. This powerful acceleration demonstrates the cash-generative nature of the mature SaaS business model and provides the company with substantial financial flexibility. It's truly a validation of the long, arguably painful transition they undertook. The cash is flowing now.
That's incredible. A strong balance sheet is always a good indicator of financial health and flexibility, too. How does Pega stack up here? Any red flags?
No, quite the opposite. Pegasystems maintains a strong and liquid balance sheet, which supports its strategic investments and capital return programs. As of the end of fiscal year 2024, the company reported a robust cash investments position of $1.23 billion with no debt.
No debt. That's impressive.
It is. More recent data for the trailing 12 months shows cash and cash equivalents of about $411 million and total debt of just $79 million, resulting in a healthy net cash position of around $333 million. The company also maintains a positive working capital position, last reported at $246 million, indicating sufficient short-term liquidity. So yeah, it gives them a strong foundation.
Okay, so if we look beyond the traditional GAAP numbers, which can be misleading during these transitions, what do the core SaaS metrics tell us about the underlying health and momentum of the business? These are the numbers investors really lean on, right?
Absolutely. Given the limitations of traditional GAAP accounting during a SaaS transition, management has consistently directed investors to focus on a set of forward-looking metrics that better reflect the underlying health and momentum. Annual contract value, or ACV, is the primary performance metric they use. It measures the annualized value of its active contracts. As of June 30, 2025, total ACV reached a milestone of $1.514 billion. That represents 16% year-over-year growth on a reported basis, or 14% in constant currency. Now, the growth is overwhelmingly driven by Pega Cloud ACV. That surged 28% year-over-year, or 25% in constant currency, to $761 million.
28% cloud ACV growth, okay.
Yes, and this segment now constitutes over 50% of the total ACV. That's a critical milestone in the company's transformation, crossing that halfway point. In contrast, Client Cloud ACV, which includes the legacy maintenance and on-premise term licenses, grew by a modest 6% or 4% in constant currency for $753 million. The stark divergence in these growth rates provides the clearest quantitative evidence of the successful strategic pivot to the cloud.
So the numbers are clearly pointing to a successful shift.
Yeah.
But what does this translate to in real-world impact? Can you give us a tangible example of how this growing backlog, the RPO you mentioned, actually benefits Pega's day-to-day operations or their ability to invest?
That's a great question because these aren't just abstract figures. Let's talk about that remaining performance obligation, or RPO, also known as backlog. RPO represents all future revenue under contract that has not yet been recognized. It provides strong visibility into the future revenue stream. As of June 30th, 2025, total backlog grew by an impressive 31% year-over-year to $1.835 billion. Now, this backlog is composed of $927 million in current RPO. That's revenue expected to be recognized within the next 12 months, which was up 26%, and $908 million in long-term RPO, which was up a very strong 35%.
35% growth in the long-term backlog.
Yes. That strong growth in long-term backlog indicates that clients are signing larger, multi-year commitments, further enhancing revenue predictability. For you, the listener, what this means is Pega has a significant portion of its future revenue already locked in. It provides incredible financial stability. This allows them to confidently plan R&D investments, expand their sales force, and even return capital to shareholders, knowing their future revenue stream is much more secure than it used to be. It's a sign of a robust, predictable business model finally emerging from that transition.
Looking beyond the numbers then, what's Pega been doing recently to drive its strategic vision and ensure future growth? Any big new products or partnerships really moving the needle?
Absolutely. The most significant strategic initiative undertaken by Pegasystems in the 2024-2025 period has definitely been the launch and rapid enhancement of Pega GenAI Blueprint. This product is not merely an incremental feature, it's really a fundamental pillar of the company's go-to-market strategy and its vision for the future of application development. Blueprint is an AI-powered collaborative design tool. It enables both business and IT users to generate comprehensive application workflows simply by describing their goals in natural language. It leverages generative AI combined with Pega's 4 decades of industry best practices to accelerate the initial sprint zero or design phase of a project. This phase traditionally took weeks of workshops, but now it can potentially be done down in a matter of hours.
That sounds like a game changer. How exactly does that accelerate something that typically takes weeks? Can you give us an example? It sounds almost too good to be true.
Well, think about it this way. Traditionally, getting all the stakeholders in a large enterprise, different departments, different levels, to agree on complex process, like a new loan application system, involves endless workshops, whiteboarding sessions, drafting long documents, back and forth.
The meeting marathon.
Exactly, the meeting marathon. Blueprint aims to streamline this massively. Users can simply type out their requirements in plain English, like, I need a workflow for home loan applications that checks credit, verifies income, and sends approvals. The AI then instantly generates a visual workflow map, suggested data models, even basic user interfaces. Stakeholders can immediately see and interact with this blueprint, making rapid adjustments collaboratively. It turns weeks of abstract discussion into hours of concrete design. Crucially, recent enhancements have transformed Blueprint Blueprint into a powerful tool for legacy system modernization. The platform can now ingest and analyze existing enterprise assets like old BPMN files, data from process mining tools, database schemas, API documentation, and automatically generate functional blueprints for modern cloud-native PEGA applications.
So it helps tackle that technical debt problem, too.
Directly. This capability directly addresses a major pain point for large enterprises burdened with technical debt. The strategic importance of Blueprint is underscored by its integration into essentially every sales campaign. It is being positioned as a game changer that allows PEGA and its partners to rapidly prototype solutions and demonstrate value to prospective clients much faster. The tool is also being adopted by major systems integrators like Accenture and Cognizant, who can create their own branded versions of Blueprint to accelerate their consulting engagements. And here's the kicker. By offering this powerful design tool for free, Pegasystems is effectively lowering the barrier for enterprises to engage with its ecosystem, embedding them in the PEGA methodology well before a formal procurement decision is even made.
Giving away the design tool for free, that's a bold move.
It is, but it's strategically smart. It creates a powerful advantage in a long and competitive sales cycle. Get them using your way of thinking early on.
And how are they strengthening their overall ecosystem to scale their reach, especially when going up against those tech giants with massive sales forces? Relying solely on direct sales must be tough.
You're right, it is. So in conjunction with its product strategy, Pegasystems has made significant moves to strengthen and evolve its partner ecosystem with a clear focus on collaborating with hyperscale cloud providers. The company announced a multi-year collaboration with Amazon Web Services, or AWS, to integrate AWS's suite of generative AI services directly into the PEGA platform. It has also expanded its partnership with Google Cloud, allowing customers to leverage Google's AI models, including Gemini and Claude, through the PEGA Connect Gen AI framework. These partnerships are a key pillar of their strategy. They provide clients with choice and broaden the set of enterprise workloads that can be addressed by the PEGA platform. This is all part of a deliberate shift towards a more scalable, partner-led go-to-market model.
Moving away from just direct sales.
Exactly. This is evidenced by the recent high-profile executive hires from AWS and Microsoft, people who have deep experience in building partner co-selling motions. The goal is to leverage the vast sales and delivery capabilities of global systems integrators and cloud providers to reach a broader market more cost-effectively than through a direct sales-only approach. It's a smart way to scale without needing to build an equivalent direct sales army to compete with the giants.
Any notable changes in the leadership team to help steer this strategic pivot and push for new growth? New faces?
Yes, to support these strategic pivots, Pegasystems has made several key leadership appointments and organizational adjustments. In July 2025, the company appointed Daniel Kassoun as the new head of its global partner ecosystem. He is an industry veteran with extensive experience building partner organizations at both AWS and Microsoft, so his hiring signals a clear intent to accelerate growth through these strategic alliances. Back in September 2024, Pegasystems created the new executive role of a chief cloud officer, appointing company veteran Frank Guerrera to the position. This move was designed to dedicate senior leadership focus specifically to accelerating the adoption of PEGA Cloud among its client base. Alongside these appointments, the company has undertaken a right-sizing of its sales force to improve role clarity, focus, and overall efficiency. Management noted on recent calls that these changes are yielding positive results in 2025. So yes, they're putting leadership muscle behind these strategic directions.
What about the broader economic picture? We've seen a lot of volatility, talk of slowdowns. How are they navigating potential macroeconomic headwinds? Are enterprises still investing in these big transformation projects?
That's definitely something they're watching. Management has been transparent about the impact of the broader macroeconomic environment on its business and outlook. The company's financial guidance for 2025 has been described as cautious, explicitly accounting for potential headwinds from a strong U.S. dollar and the risk of a slowdown in overall enterprise IT spending. Despite this caution, however, the demand for AI-driven transformation appears to be quite resilient. In its Q2 2025 earnings call, management noted a slightly improved macro outlook compared to 90 days prior and stated that they had seen no material impact from tariffs.
So demand is holding up for now.
It seems so. The strong growth in backlog and ACV suggests that enterprises continue to prioritize strategic transformation projects, even in an uncertain economic climate. These are often seen as must-do projects for long-term competitiveness, perhaps less discretionary than other types of IT spending.
And any notable corporate actions recently that investors should know about? Stock splits, dividends.
Yes, a couple of things. In June 2025, shareholders approved a 2-for-1 stock split, which was effected in the form of a stock dividend. This action was intended primarily to increase the liquidity of the company's shares, make them more accessible, perhaps. Following the split, the company also announced a quarterly cash dividend of 6 cents per share on a post-split basis, continuing its policy of returning capital to shareholders, albeit modestly, through the dividend.
Okay, so they've laid the groundwork, successfully navigated a major transition, and are innovating with things like Blueprint. Where are the biggest growth opportunities for Pegasystems moving forward? What's their long-term vision look like?
Well, a significant opportunity definitely lies in the expansion in international markets. Their international operations already account for a substantial portion of revenue, representing about 44% of the total over the last 3 years. Recent strategic initiatives indicate a continued focus on global expansion. The company has announced a strategic talent development partnership aimed at India, the Asia-Pacific, or APAC region, and the Middle East. This is designed to build a skilled workforce to support growth in these key regions. Furthermore, it has expanded its cloud infrastructure footprint, launching PEGA Cloud, hosted by Google Cloud in the Kingdom of Saudi Arabia, to better serve clients in that market. The APAC region in particular is viewed as a key long-term growth vector because many of these countries are rapidly digitizing and have large, complex organizations that fit PEGA's sweet spot.
And within their existing customer base, those blue-chip clients, is there still room to grow there? Or have they kind of saturated those accounts already?
Oh, absolutely not saturated. The primary growth strategy for Pegasystems remains a classic land and expand model within its target market of large, complex enterprises. The company's deep entrenchment in these accounts provides fertile ground for growth through 2 main avenues. First, cross-selling. They leverage an initial successful deployment in one part of an organization, say automating a customer service process, to sell into other departments or business lines. For example, implementing the 1.1 customer engagement suite for the marketing department after a successful service project. And then there's upselling to the cloud. A significant opportunity still exists to migrate the portion of the customer base that remains on-premise or client-managed deployments to the higher-value Pega Cloud platform. With over 50% of clients now on Pega Cloud, there is still substantial runway to convert the remaining customers.
So still plenty of room within existing clients.
Definitely. Plus, the continuous introduction of new premium AI-powered modules and capabilities creates ongoing opportunities to upsell additional functionality to the existing installed base. They're constantly looking for new ways to solve more problems for existing clients, which drives growth.
Here's where it gets really interesting again. Pega's bold vision for the future of enterprise automation and AI. It seems to go beyond just workflow. Can you tell us about this agentic process fabric concept and how it positions them for the future? That sounds futuristic.
It is quite forward-looking. The company's innovation pipeline is squarely focused on extending its leadership in AI-powered automation. The overarching strategy is to position Pega as the central nervous system for what they call the autonomous enterprise. As we detailed previously, the core product differentiator is that combination. Generative AI for design and collaboration via Blueprint, paired with more deterministic, rules-based AI for execution within the Infinity platform. That approach provides the control and governance required for mission-critical enterprise use cases. But a truly forward-looking concept representing Pega's strategic vision is the agentic process fabric. To give you a simple analogy, think of it like a conductor leading a vast orchestra where some musicians are humans and others are advanced robots or different specialized AI tools from various vendors. Pega wants to be that conductor.
Orchestrating humans and AI agents together.
Precisely. The goal is to create an orchestration layer, a fabric, that can manage and coordinate a hybrid workforce of human employees and various AI agents, both Pega's own and those from third parties, across disparate enterprise systems. This ambitious vision aims to position the Pega platform as the essential command and control center for all automated work within an enterprise. That's a highly strategic and defensible position to aim for. If successful, this would make Pega potentially indispensable because it would provide the governance and orchestration layer that manages the inevitable proliferation of various AI tools rather than being replaced by them. For our listeners grappling with integrating AI into their own companies, the most important takeaway is that Pega is offering a solution not just to implement AI, but to manage and govern all your AI, ensuring consistency, auditability, and control across the board.
That's a powerful vision indeed. It sounds like they're strategically positioned to capitalize on some of the biggest trends in business. What makes them uniquely suited for these secular tailwinds like digital transformation and enterprise AI?
They absolutely are well-positioned. Pegasystems is set up nicely to benefit from the powerful secular tailwinds of digital transformation and the enterprise-wide adoption of AI. As organizations of all types seek to modernize legacy systems, improve efficiency, and deliver more personalized customer experiences, the demand for sophisticated workflow automation and decisioning platforms is expected to remain robust. Pega's strategic focus on providing a governed, scalable, and controlled platform for deploying AI in critical business processes directly aligns with the needs of its large enterprise and public sector clients. These clients must balance the imperative to innovate with the need for security, compliance, and predictability. So Pega's not just riding the wave, they're arguably providing the surfboard or maybe the navigation system for these large, complex organizations trying to navigate the AI revolution. A particularly significant, though perhaps longer-term, growth opportunity may lie within the public sector. Government agencies at all levels are quintessential examples of large, complex organizations burdened by legacy systems and driven by intricate, rules-based processes.
The ultimate complex processes, maybe.
Quite possibly. These agencies are typically slower to adopt new technology but represent a massive, underserved market for digital transformation. The core requirements of government processes, things like benefits processing, licensing, case management, align perfectly with Pega's strengths in workflow automation and dynamic case management. Furthermore, the high degree of security, auditability, and governance required in the public sector makes Pega's predictable AI framework a particularly strong fit. As these agencies are inevitably forced to modernize their decades-old systems, Pegasystems is uniquely positioned to capture a substantial share of this large and durable market.
Okay, moving to financial stewardship. How does PEGA manage its capital and aim to reward its shareholders? Has that strategy changed significantly now that they've matured into a SaaS company, generating significantly more cash?
Yes, Pegasystems' approach to capital allocation has definitely evolved in lockstep with its business model transition. During the peak investment years of the shift to the cloud, the primary focus was, understandably, on reinvesting capital to drive growth, get that cloud business scaled. More recently, as the company has emerged as a profitable, cash-generative SaaS business, the strategy has shifted to a more balanced approach. This combines continued investment in innovation with a significant return of capital to shareholders. This is consistent with management's stated focus on operating with that Rule of 40 mindset, which balances growth with profitability. It's a sign of maturity and confidence in their cash flows.
Tell us about their dividend policy again. What kind of signal does that modest dividend send to shareholders?
Right. The company has a history of providing a regular return to shareholders through a quarterly cash dividend. In June 2025, following that 2-for-1 stock split, the company's board announced a quarterly cash dividend of $0.06 per share on a post-split basis. Based on recent stock prices, this represents an annualized dividend of $12 per share and a dividend yield of approximately 0.23%.
So not a high yield.
No, it's modest. But the consistent payment of a dividend signals stability, a commitment to shareholder returns, and confidence in the underlying health of their cash flows. It's more symbolic than substantial, perhaps, but it's a positive signal nonetheless.
And what about share repurchases? You mentioned those earlier. How aggressive are they with buying back their own stock, and what does that imply?
Yeah.
That seems like the bigger part of the return story.
It absolutely is the bigger part right now. As free cash flow has accelerated dramatically in 2025, Pegasystems has become notably more aggressive with its share repurchase program. This has clearly become the primary vehicle for returning capital to shareholders lately. In the first half of fiscal 2025, the company repurchased approximately $251 million of its common stock. Now, consider this. That represented over 85% of the total free cash flow generated during that same period.
85% of FCF went to buybacks.
Yes. That indicates a very strong commitment to the buyback program. Such an aggressive repurchase program is a powerful signal of management's confidence in the company's future cash-generating capabilities, and arguably their belief that the company's stock is trading below its intrinsic value. When management is buying back shares that aggressively, it usually suggests they see a compelling opportunity in their own stock price.
Where are they putting their money to ensure future innovation and growth beyond those buybacks? Where's the R&D focus?
They continue to invest heavily in research and development to maintain their technological leadership, particularly in AI and workflow automation. R&D spending is a significant component of their operating expenses. Historical figures were reported at $413 million in 2022 and approached $508 million in another recent annual period. That's a substantial investment. These investments are critical for funding the innovation pipeline, including the development of PEGA GenAI blueprint and that ambitious agentic process fabric vision we discussed. Their acquisition strategies is described as selective, focused on acquiring complementary technologies rather than pursuing large transformative mergers. So R&D is still a major priority.
How transparent and engaged are they with the investment community? Do investors feel they have a clear line of sight into the company's strategy and performance?
Generally, yes. The senior leadership team, led by founder and CEO Alan Trefler and CFO Ken Stillwell, maintains a high level of engagement with the investment community. They regularly communicate the company's strategy, financial performance, and outlook through quarterly earnings calls and frequent presentations at major investor conferences. They seem quite accessible. The company's capital return policy, that combination of a small but consistent dividend with a large and opportunistic share buyback program, appears designed to appeal to a broad range of investors. The dividend provides a signal of stability and maturity, attractive maybe to income-oriented shareholders, while the substantial buyback program appeals more to growth-oriented investors by being accretive to earnings per share and signaling management's belief that the stock is undervalued. This dual approach might be a deliberate strategy to broaden the company's shareholder base as it completes its evolution into a mature, cash-generative SaaS leader.
What's fascinating here is no company, no matter how strong, is without risks, and Pega operates in a challenging competitive environment. What are the key headwinds, the potential roadblocks that investors really need to be aware of?
That's a crucial point, and it's important to acknowledge the significant risks. Pega operates in a fiercely competitive environment. First, just intense competition. They're facing off against some of the world's largest and most well-resourced software companies, as we've discussed. Competitors like Salesforce, Microsoft, ServiceNow, and Oracle possess significantly greater financial, sales, and marketing resources, plus broader brand recognition. These rivals can leverage their scale and extensive product portfolios to engage in aggressive bundling and pricing strategies, which could definitely erode Pega's market share and pricing power over time. Imagine Microsoft bundling Dynamics 365 with Office 365 and Azure at a deep discount. That puts serious pressure on focused players like Pega. Second, technological disruption. The rapid pace of innovation in artificial intelligence represents both an opportunity and a significant threat. If competitors develop a superior approach to enterprise AI, or if Pegasystems fails to execute effectively on its own AI roadmap, its core technological differentiation could be diminished. They need to stay ahead. Third, industry and customer concentration. The company's business is heavily concentrated among large enterprise clients within a few key, highly regulated industries, primarily financial services, insurance, and healthcare. This focus, while a source of deep domain expertise, also creates a vulnerability. A significant downturn, a wave of consolidation, or an adverse regulatory shift within these specific sectors could have a disproportionately negative impact on Pegasystems' financial performance compared to more diversified vendors.
And how sensitive are they to the broader economic climate? Do their sales cycles just grind to a halt when there's economic uncertainty?
As a provider of high-value strategic enterprise software, Pegasystems is inherently sensitive to corporate IT spending cycles. The company's solutions often represent multi-million-dollar, multi-year commitments that are central to a client's digital transformation strategy. These aren't small purchases. During periods of significant economic uncertainty or recession, chief financial officers are naturally more likely to delay or reduce spending on such large-scale strategic projects in favor of preserving capital. This makes Pega's sales cycle potentially more procyclical and its growth more vulnerable to macroeconomic shocks compared to vendors selling smaller, department-level solutions that might be seen as less discretionary. It's harder to pull the trigger on a multi-million-dollar commitment when budgets are tight.
Now, every strong company faces challenges, but Pega has a particularly large one casting a shadow. Let's talk about the legal battle that's making headlines. Here's where it gets really interesting and quite impactful for potential valuation. The elephant in the room, perhaps.
Indeed, and this is undeniably the most significant and acute risk facing the company right now, the Appian litigation. Pega is currently appealing a Virginia trial court judgment of over $2 billion related to claims of trade secret misappropriation brought by competitor Appian. An unsuccessful appeal could have a material, truly adverse impact on the company's financial condition, operating results, and strategic flexibility. The sheer magnitude of the judgment is substantial. We're talking over $2 billion. That represents more than 20% of their current market capitalization, which is around $9 billion, and a huge chunk of its net cash position.
$2 billion. That's not just a number. It feels like a sort of Damocles hanging over the company, as the saying goes. How do you even begin to factor that kind of binary uncertainty into an investment thesis, especially when the impact goes beyond just the financial penalty?
That's precisely the challenge for investors right now. It's incredibly difficult. A final adverse ruling would likely require the company to take on significant debt or issue a highly dilutive amount of equity to satisfy the judgment. This would severely constrain its ability to invest in R&D, pursue acquisitions, or return capital to shareholders for potentially years. This legal uncertainty currently acts as a significant overhang on the stock's valuation, no question about it. Beyond the direct financial penalty, there's also reputational risk. The nature of the allegations, trade secret misappropriation, could cause prospective customers and potential partners to hesitate in engaging with Pegasystems, particularly given the company's focus on trust and partnership with large, often conservative enterprises. If you're a Fortune 500 company making a multi-year, multi-million-dollar commitment, you want absolute confidence in your vendors' integrity and practices. And finally, related to, but separate from the litigation, is the risk around evolving AI regulations. The global regulatory landscape for artificial intelligence is still nascent, fragmented, and rapidly evolving. The imposition of new laws and regulations governing the use of AI in various jurisdictions could increase compliance costs for PEGA, require modifications to their products, and potentially restrict the deployment of certain AI-driven features, thereby impacting the company's innovation and growth potential. It's a confluence of legal, reputational, and regulatory uncertainty.
And what about the execution of their own internal strategies? Are there risks related to their big shifts, like managing the final stages of the cloud transition or making that new partner model work effectively?
Yes, execution risk is always present. While the transition to a cloud-first model has been largely successful, there's still cloud transition management risk. They must continue to manage the migration of their remaining on-premise customer base. This process can create short-term volatility in revenue recognition and requires careful management to ensure customer satisfaction during the move. You don't want to alienate long-term clients. And then there's the go-to-market shift risk. The strategic pivot to a more partner-centric sales model is a significant undertaking. Successful execution depends entirely on the company's ability to effectively recruit, enable, and motivate a global ecosystem of systems integrators and cloud providers. Failure to do so could result in channel conflict, inconsistent service delivery quality, and an inability to achieve the desired scale, which would directly impact growth. Making partnerships work well at scale is notoriously tricky.
Okay, so we've dissected the company, its market, its financials, its innovations, and its significant risks. Now, let's try to put it all together and talk about how the market is currently valuing Pegasystems. What do the key metrics tell us?
Right. As of late August 2025, Pegasystems valuation reflects a company that has, as we've discussed, successfully navigated a major business model transition and is now being valued more on its cash flow and growth potential as a SaaS entity, albeit with that legal cloud overhead. Their market capitalization is approximately $9.0 billion to $9.3 billion. With their net cash position, the enterprise value, or EV, is slightly lower, around $8.7 billion to $8.9 billion. The PE ratio on a trailing 12-month basis is in the range of 46x to 48x. Now, that appears high on a standalone basis.
Yeah, 47 times earnings sounds pretty steep.
It does, but it's important to remember this is distorted by non-cash charges like stock-based compensation and, crucially, the lingering accounting effects of the shift from recognizing big chunks of upfront license revenue to recognizing subscription revenue ratably over time. DAP earnings are still catching up to the cash flow reality.
That PE does sound quite high. For those listeners trying to make sense of these numbers, especially after a SaaS transition, what other metrics might be more meaningful for a company like PEGA?
That's a great question because different metrics definitely tell different stories here. Looking at other common multiples, their EV revenue is approximately 5.3x, based on that roughly $8.9 billion EV and $1.68 billion TTM revenue. If EBITDA is around 30x, based on the $8.9 billion EV and $294 million TTM EBITDA. But as you rightly point out, for a company emerging from this kind of business model transition, EV to free cash flow, or EV/FCF, is often a much more meaningful metric. It values the company based on its actual ability to generate cold, hard cash. At approximately 22x, based on the $8.9 billion EV and $406 million TTM FCF.
22 times free cash flow. That sounds more reasonable.
It does. It reflects a robust trailing 12-month free cash flow margin of around 24%. This multiple provides, I think, a clearer lens through which to assess the company's valuation relative to its peers and growth prospects, as it strips out much of the accounting noise and focuses on actual cash generation.
How does PEGA's valuation stack up against its key competitors in the enterprise software space? Using those more relevant metrics, are they trading at a discount or a premium, and what are the implications of that?
A comparison of Pegasystems' valuation to its key competitors reveals a mixed picture, highlighting its unique position. From a relative standpoint, Pegasystems trades at a significant valuation discount to the high-growth market leader ServiceNow across pretty much all metrics. For instance, that EV/FCF of around 22x for Pega versus something closer to 47x for ServiceNow.
Wow, less than half the FCF multiple of ServiceNow.
Yes. Compared to Salesforce, Pega trades at a premium on those GAAP PE and EV/EBITDA metrics, but at a slight discount on EV revenue and actually a premium on EV/FCF. Its valuation appears richer than that of the scaled, mature tech giants Microsoft and Oracle on most metrics, which might be justified by its higher potential growth rate from a smaller base, or maybe it's just reflecting the market's focus on that pure-play automation story. Historically, remember, the company's enterprise value peaked at nearly $11 billion back in late 2020 before crashing to a low of $3.2 billion at the end of 2022 during the broader tech market downturn and peak uncertainty around its transition. The current EV of approximately $8.9 billion represents a substantial recovery but remains below its prior peak.
So that discount to ServiceNow, does that imply the market expects lower growth from Pega, or is it mostly that litigation risk being priced in?
I think it's likely a combination, but the litigation overhang is almost certainly a major factor depressing the multiple compared to a cleaner story like ServiceNow. The market hates uncertainty, especially legal uncertainty of this magnitude.
For those listeners who like to build their own models, what would a discounted cash flow analysis look like for Pega? What would be the critical assumptions that would really move the needle in that kind of intrinsic valuation?
Right. A discounted cash flow, or DCF analysis, is always highly dependent on the assumptions you plug in, especially for a company still showing strong growth potential. A baseline framework for valuing Pegasystems would probably incorporate a forecast period of, say, 10 years. Revenue ACV growth would be key. You'd likely start in the low to mid-teens percentage-wise, consistent with recent performance and management guidance, and then gradually taper that down to a terminal growth rate over the decade. The free cash flow margin would be arguably the most critical assumption. You'd project margins expanding from the current TTM level of around 24% steadily towards management's long-term target, which they've indicated is in the mid-30% range. This reflects the expected operating leverage and the high-margin nature of a mature SaaS model.
So getting that margin expansion path right is crucial.
Absolutely. Then you'd need a discount rate, WACC, probably in the range of 8% to 10%, reflecting the systematic risk of the enterprise software industry and Pega's specific risk profile. And finally, a terminal growth rate of maybe 2.5% to 3.0%, in line with long-term expectations for global GDP growth. The biggest levers in any Pega DCF right now are going to be the pace and extent of that FCF margin expansion and the sustainability of double-digit ACV growth. The market's current valuation, around that 22x FCF multiple, appears to be pricing in a scenario of sustained double-digit ACV growth and significant margin expansion. However, it is also abundantly clear that the stock's valuation is being suppressed by that litigation discount. As we said, the potential $2 billion liability from the Appian case represents over 20% of the company's current market capitalization. A favorable resolution like a successful appeal that completely overturns the judgment, or even a much smaller settlement, could act as a significant, almost immediate catalyst for a positive re-rating of the stock's valuation multiples independent of the company's underlying operational performance. It's almost a binary event risk-reward scenario layered on top of the operational story.
This raises an important question about the people making the decisions. How strong is the leadership team, and what kind of corporate governance is in place at Pegasystems? Especially given that founder-led structure, how does that balance long-term stability with shareholder interests?
That's a key aspect of the Pega story. The company is led by its founder, Alan Trefler, who has served as chief executive officer since the company's inception way back in 1983. This extraordinarily long tenure provides a level of strategic consistency and long-term vision that is genuinely rare in the technology industry today. Mr. Trefler is widely regarded as a visionary in the software space, having pioneered the model-driven, low-code approach that is now a major industry trend. His background as a world-class chess master is often cited, maybe apocryphally, as an influence on his strategic, long-term approach to building the business. He's supported by an experienced senior leadership team with an average tenure of around 6.9 years, indicating a stable and cohesive management group. Ken Stillwell, the COO and CFO, is another key public-facing executive who has been really instrumental in guiding the company through its financial transformation and communicating its strategy effectively to investors.
Are there incentives aligned with shareholders, especially with such a long-term vision at the helm? How does their compensation work?
Executive compensation at Pegasystems appears to be structured primarily to align the interests of management with those of shareholders, particularly long-term shareholders. For the most recent reported year, CEO Alan Trefler's total compensation was around $7.7 million. Critically, only about 7.4% of this amount was comprised of his base salary. The remaining 92.6% was tied to performance-based bonuses, stock awards, and options, directly linking the vast majority of his pay to the company's success and stock performance. The 2025 Corporate Incentive Plan for Executive Officers further reinforces this alignment. Potential bonuses are determined by a formula where 75% of the evaluation is based on achieving specific financial goals, like ACV growth and profitability targets, and the remaining 25% is tied to achieving strategic objectives. So yes, their pay seems directly linked to the company's financial and strategic success.
And what about the board and how corporate decisions are made, particularly with the CEO also being the chairman? Is there enough independent oversight?
That's a fair question. The company's board of directors is composed of a mix of inside and outside directors. Pegasystems' corporate governance guidelines state that the board believes a majority of its members should be independent directors, as defined by NASDAQ rules. The board maintains standard committees, an audit committee, a compensation committee, and a nominating and corporate governance committee, each of which is required by NASDAQ rules to be composed entirely of independent directors. A key governance feature, as you noted, is that the roles of chairman of the board and chief executive officer are currently combined and held by Alan Trefler. The company's guidelines state that the board retains the flexibility to either combine or separate these roles as it sees fit, allowing for the designation of a lead independent director when the roles are combined, which provides a channel for independent director oversight.
What's truly fascinating here, though, and a really defining characteristic of Pegasystems, is the level of insider ownership. What are the implications of the founder holding such an incredibly large stake? That must influence things significantly.
It absolutely does. Founder control is exceptionally high, perhaps the defining feature of their governance. CEO Alan Trefler maintains a very large ownership stake in the company, last reported at 45.38% of the total shares outstanding. That's a position valued at over $4 billion. Total insider ownership is approximately 46.25%.
Nearly half the company owned by insiders, mostly the founder.
Exactly. This level of founder ownership is extraordinarily high for a publicly traded company of this size, and is arguably the single most important governance factor to understand. On the one hand, it ensures an unwavering focus on the long-term strategic vision, insulating management from the pressures of short-term activist investors who might push for different strategies. This control was likely instrumental, absolutely essential perhaps, in allowing the company to execute its multi-year cloud transition, which, as we know, negatively impacted short-term financial results but set them up for long-term success. The corollary, however, the other side of that coin, is that minority shareholders have very limited ability to influence corporate strategy or governance. It creates a structure somewhat akin to a benevolent dictatorship, where investors are essentially making a direct bet on the founder's vision, judgment, and execution ability. Your interests are aligned with his long-term view, or you probably shouldn't be invested.
So effectively, if you invest in PEGA, you're investing very directly in Alan Trefler's long-term vision and trusting his stewardship. We also saw some insider trading data mention more sales than buys recently. What should listeners make of that? Is it a red flag?
Right. As for recent trading activity, an analysis of insider trading over the last 12 months does show a significantly higher volume of sales than buys, 147 sell transactions versus only 10 buy transactions were noted in one report. However, a closer look reveals that a large portion of this sales volume is attributable to CEO Alan Trefler through automatic sell transactions. These are typically part of prearranged 10b5-1 trading plans. These are common and legitimate ways for executives with substantial equity holdings, like Trefler, to diversify their personal wealth over time in a structured, planned manner without raising concerns about trading on inside information.
So planned sales, not panic selling.
Correct. While the high volume of sales might appear concerning at first glance, the pre-scheduled nature of these 10b5-1 transactions mitigates the risk that they are based on negative near-term information. Perhaps more telling is the relative absence of significant unscheduled open market purchases by insiders. That would be a stronger positive signal of deep undervaluation. The sales are somewhat expected, given the sheer size of Treffler's holding and the need for diversification over decades, but the lack of large, spontaneous buys means insiders aren't actively signaling they think the stock is dramatically cheap right now, despite the buybacks.
We've covered an incredible amount of ground, really diving deep into Pegasystems' business, financials, strategy, risks, and governance. So as we wrap up, what are the critical factors that will truly drive its performance from here? What should we, as listeners, be watching most closely for signs of outperformance or, conversely, underperformance?
Okay, boiling it down. The future performance of Pegasystems stock will likely be driven by the interplay of several critical factors. For potential outperformance, I'd watch for the continued and ideally accelerating adoption of PEGA GenAI Blueprint. If this tool can demonstrably shorten enterprise sales cycles and drive net new ACV growth significantly above the company's guidance, that could lead to upward revisions in revenue and cash flow forecasts, boosting the stock. Successful execution of the new partner-led go-to-market strategy is another key driver. Effectively leveraging global systems integrators and hyperscalers could unlock broader, more cost-effective market reach. But perhaps the most significant potential catalyst, the real wild card, would be a favorable outcome in the Appian litigation.
Resolving that $2 billion question mark?
Exactly. Either a successful appeal that overturns the judgment entirely or a settlement for a much, much smaller amount would remove a significant financial and reputational overhang, likely triggering a substantial positive re-rating of the stock almost regardless of near-term operations. For potential underperformance, a sharp and prolonged global economic recession that leads to a significant contraction in large-scale enterprise IT spending is a primary external risk. This could halt PEGA's ACV growth momentum as clients delay or cancel major transformation projects. Increased competitive pressure, particularly from Microsoft's ability to bundle its Dynamics 365 and Power Platform offerings, could erode PEGA's pricing power and win rates. And of course, the flip side of the litigation coin. A final unsuccessful appeal in the Appian case, confirming that roughly $2 billion liability. That would be a major negative event, severely impacting the company's balance sheet, strategic flexibility, and shareholder returns for a long time.
This brings us to a crucial, maybe even existential question for PEGA. Can they truly maintain their specialized premium positioning in a world that seems to be moving towards more accessible, often cheaper, good enough LCNC tools offered by the giants like Microsoft and Salesforce? How defensible is their high-end niche, really?
That's a key strategic question for their long-term sustainability, absolutely. How durable is that competitive moat? As competitors like Salesforce, Microsoft, and ServiceNow rapidly enhance their own enterprise-grade AI offerings with improved governance and industry-specific models, PEGA must continuously innovate at a rapid pace just to maintain its differentiation based on providing that controlled, auditable, predictable AI environment. PEGA also needs to successfully continue articulating why its platform's depth, scalability, and governance capabilities for complex, mission-critical processes justify its premium price point against that rising tide of simpler, often much cheaper, LCNC solutions. The key insight here, the argument they need to win repeatedly, is that for their clients' most critical, complex, regulated operations, good enough is simply not good enough. Winning this value proposition argument consistently is central to their sustained competitive position and premium pricing.
For our listeners trying to track this complex story, what are the absolute must-watch metrics to monitor going forward to gauge PEGA's progress? What should be on their dashboard?
Okay, if you want to track the company's progress against its strategic objectives, I'd focus on these key metrics. First and foremost, the PEGA Cloud ACV growth rate in constant currency. This remains the most important single metric for gauging the health of their core growth engine. Sustained growth above 20% would be a strong positive signal, while a consistent deceleration into the low teens would definitely be a cause for concern. Second, monitor the company's progress in expanding its free cash flow margin. Watch the trend from its current TTM level of around 24% towards management's long-term target in the mid-30% range. That expansion is key to the investment thesis. Third, look at net new ACV additions quarterly. This provides the clearest near-term indication of new business momentum and sales execution. And finally, as the new partner-centric strategy matures, keep an eye out for any disclosures related to the percentage of partner-influenced revenue. Any concrete data here will be critical for validating whether that strategic shift is actually working and driving scalable growth.
So when we look at the whole picture, the strengths, the weaknesses, the opportunities, the massive litigation risk. What's the overall risk-reward proposition for Pegasystems compared to their peers? Where does PEGA fit in that complex enterprise software ecosystem for an investor?
Pegasystems definitely offers a distinct risk-reward profile within the enterprise software sector. It presents the opportunity to invest in a company that has, by most accounts, largely completed a difficult but successful business model transition. It's now beginning to demonstrate the powerful cash-generative characteristics of a mature SaaS business. Its defensible niche in high-end, complex automation, combined with a potentially significant growth catalyst from its innovative AI strategy, like Blueprint and the Agentic Fabric vision, offers a compelling path to value creation. However, the risks are equally distinct and significant. The company faces intense, escalating competition from the largest and most powerful software companies in the world. And crucially, there's that binary risk associated with the Appian litigation, which represents a material threat that is pretty much unique among its direct peer group right now. So compared to a market leader like Salesforce, Pegasystems offers a potentially higher growth trajectory from a much smaller base, but it comes with significantly higher execution risk and that unique, massive legal overhang. Compared to a high-growth, premium-valued peer like ServiceNow, Pegasystems offers a much more reasonable valuation, particularly on that free cash flow basis we discussed, but it has a less dominant overall market position and, historically, a lower growth rate. And compared to legacy giants like Microsoft and Oracle, Pegasystems offers a more focused, pure-play investment in the compelling themes of intelligent automation and digital transformation, but clearly without the safety net of their fortress-like balance sheets and highly diversified business models. It's definitely not an investment for the faint of heart, I would say, but one with potentially significant upside if those specific identifiable risks are managed or resolved favorably.
Wow, that was truly a deep dive. We've unpacked Pegasystems' journey from a BPM specialist to an enterprise transformation leader, its strategic pivot to the cloud, the fascinating and fierce competitive landscape, the impressive acceleration in cash flow, and the ambitious vision for AI orchestration. But we've also squarely faced the significant challenges, particularly that multi-billion-dollar legal question mark that makes this such a compelling and perhaps nerve-wracking story to follow.
Absolutely. What we've seen today is a company with strong competitive moats, rooted in complexity and deep industry knowledge, and genuinely exciting innovation, particularly around AI, governance, and design. But this is balanced by specific, weighty risks, competition, and litigation that demand very careful consideration. It's a compelling case study in how strategic shifts, even painful ones like their cloud transition, can reshape a company's future, but also how external factors can loom large. For you, the listener, understanding the nuanced interplay between Pega's unique strengths and these very real challenges is absolutely key to being truly well-informed.
For you, our curious listener, here's a final thought to chew on. Considering Pega's unique founder-led structure, with that massive ownership stake, and its strategic vision of an agentic process fabric orchestrating both humans and AI, what new challenges and opportunities might arise when a single long-term vision guides not just human workflows, but potentially an entire enterprise of diverse AI agents? Think about the implications, the power, and the potential pitfalls of having a central AI brain guided by one core philosophy for your entire business. Thank you for joining us on this deep dive. We hope this has given you a valuable shortcut to being truly well-informed about Pegasystems. We'll catch you on the next one.